All right, welcome back to the deep dive. Today we're diving into something really, really crucial. The kind of stuff that makes or breaks any business, no matter how big or small. We're talking about business finance.
Yeah, and it's not just for accountants or number crunchers, you know.
Absolutely.
This is for everyone.
This is about making smart decisions.
Absolutely.
Whether you're pricing your products, managing costs, or, making those big investment calls, understanding this stuff really gives you an edge. I mean,
Yeah.
let's be honest, you could have the most brilliant idea in the world, but
If you don't get the finance part right, you're going to struggle.
yeah, it all falls apart. And for this deep dive, we've got an awesome resource to guide us, a GCSE Business Finance Guide.
Now, don't let the GCSE bit fool you. This guide is super clear and covers all the fundamentals.
Yeah, it gets through the jargon and gets straight to the point, which is what we love.
Absolutely.
So what's the mission here today?
The mission. All right, so we're going to break down the absolute key elements of business finance, right? Tailored for you, our listeners. By the end of this, you'll be comfortable talking revenue, costs, profit, break-even analysis, cash flow, all that good stuff.
Without getting totally overwhelmed.
Exactly. Just the need-to-know info.
The good stuff. All right, so looking at this guide, it seems to break down into a few key sections. Revenue, costs, profit. They kind of go hand in hand, don't they?
Yeah, absolutely. You start with revenue, the money coming in.
The lifeblood.
Then you got your costs, what you spend to make it all happen. And the difference, ideally, is your profit.
Right. So revenue, that's pretty simple, right? It's the total income you get from, selling your stuff.
Yeah, sometimes called turnover or sales turnover. Basically, the money you make from selling goods or services.
Simple formula, too, isn't it?
Super simple. Revenue equals the selling price per unit times the quantity sold.
Got it. So let's say our imaginary bakery sells 150 cupcakes, and they charge £2 a pop.
That's 300 pounds revenue right there.
Easy peasy. But what about a bigger business, like a web design agency? Let's say they land 12 projects and charge £500 each.
Well, they're looking at 6,000 pounds in revenue. So, yeah, higher sales or higher prices equal more revenue.
Pretty straightforward.
It's the starting point.
Okay, so we've got the money coming in. Now we need to talk about the money going out costs.
And this is where it gets a little bit more
It's
nuanced.
a little bit more complex.
Yeah. We've got two main types, fixed costs and variable costs.
Okay, let's start with fixed. What are those?
Fixed costs are the expenses that stay pretty much the same, regardless of how much you're producing or selling, at least in the short term.
Think of it as your baseline.
Yeah, the must-haves.
Like keeping the lights on even if you don't sell a single thing.
Exactly. So think rent for your office or shop, salaries for your management team, insurance premiums, those loan repayments you got to make, maybe even a fixed advertising budget.
Okay, but these things can change, right?
Over time, yeah, for sure. Rent can go up when your lease is up. You might need a bigger space, hire more people on salaries, things like that. But relative to how much you're making or selling right now, they're pretty fixed.
Okay, I see. So they're consistent in the immediate sense, not fixed forever. That makes sense.
Yeah.
Now, variable costs, these are a bit more, variable as the name suggests.
These are directly linked to how much you're producing.
More stuff means more cost.
Exactly. More cupcakes, more ingredients.
Okay, give me some more examples.
Okay, so raw materials, more production, more materials needed, wages for production workers if they're paid per item, packaging costs, electricity to run your machines, sales commissions based on how much you sell. These all go up as your production increases.
Okay, I get it. And to calculate the total variable cost, you just multiply the variable cost per unit by the number of units you produce.
Bingo.
Okay. So we've got our fixed costs, kind of like our base expenses, and our variable costs fluctuating with activity.
And when you add those together, you get your total costs.
Total costs. Makes sense.
It's the whole picture of what you're spending.
Important formula to remember. Total cost equals fixed costs plus total variable costs.
And remember, your total costs can never really be zero.
Right, because those fixed costs are always there. The guide gives a good example, a clothing store with 800 pounds in fixed costs.
Let's say they have a variable cost of 5 pounds per t-shirt.
If they sell 50 t-shirts, their total cost is 800 pounds plus 50 times 5 pounds, which is 250 pounds.
So 10,050 total.
Okay, now we're getting somewhere. We've got revenue coming in, costs going out. The difference, hopefully, is profit.
But there's a twist.
There's always a quiz.
We're not talking about just one type of profit. We've got gross profit and net profit.
Okay, what's the difference?
Gross profit is like your first level of profit. It's what you make from your core business buying and selling before you factor in all the other expenses of running the show.
So it shows how efficiently you're managing the direct costs of making your stuff, what's often called cost of goods sold, or COGS.
Yes,
Yes.
exactly.
And how do you calculate it?
Gross profit equals revenue minus cost of goods sold.
Let's say our furniture store makes 5,000 pounds selling sofas.
And those sofas cost them 3,000 pounds to buy.
Their gross profit is 2,000 pounds.
That's the initial profit from just those sofa sales.
Got it. So that's gross profit. Now, net profit, this is the real deal, right?
The bottom line, the big kahuna. It's what's left after you've paid all your costs and expenses, not just COGS.
So we're talking rent, salaries, utilities, marketing, those loan interest payments, even taxes. It's the final profit available to the owners.
Sometimes called net income.
The bottom line.
Exactly. And the formula is net profit equals gross profit minus all those other expenses.
So our furniture store with their 2,000 pounds gross profit, let's say they have 700 pounds in other expenses.
Their net profit is 1,300 pounds.
That's the money they actually pocket after everything's paid.
A real takeaway.
And obviously, if costs are higher than revenue, that's when you're in the red, making a loss.
Nobody wants that.
All right, so we've covered revenue, costs, profit, both gross and net. Now, the guide jumps into this concept of break-even analysis. Finding that sweet spot seems pretty important, wouldn't you say?
It's crucial. This is where you figure out how much you need to sell to cover all those costs and start actually making a profit.
The point where you're not losing money, but not making it either.
Exactly. The break-even point. And you can calculate this in a couple of ways by the number of units you sell or the total value of those sales.
Okay, let's start with units. How do we find that magic number?
The formula is break-even point in units equals fixed costs divided by the selling price per unit minus the variable cost per unit. Now that bracketed part, the selling price minus the variable cost, that's your contribution per unit.
Contribution per unit, what's that all about?
It's the amount each sale contributes towards covering your fixed costs first, then towards profit once those are covered.
Okay, so each unit sold chips away at those fixed costs and then starts adding to your profit. Makes sense. Let's use an example.
Let's go back to the pottery studio. They've got 500 pounds in fixed costs per month.
Rent, insurance, all that.
They sell their mugs for 15 pounds each,
Okay.
but it costs them 5 pounds to make each mug, materials, labor, So their contribution per unit is 10 pounds.
15 pounds selling price minus 5 pound variable cost.
Now, to find their break-even point in units, we take their fixed costs, 500 pounds, and divide it by that contribution per unit, which is 10 pounds.
Which gives us 50 units.
So they need to sell 50 mugs a month just to cover their costs and break even.
51st mug, they're in profit territory.
Exactly.
Okay, now how about the break-even point in terms of the total value of sales?
Slightly different formula here. It's break-even point in value equals fixed costs divided by, and this is a bit longer, the selling price per unit minus the variable cost per unit, all divided by the selling price per unit.
Lots of dividing going on there.
That middle part, that whole chunk of selling price minus variable cost, then divided by selling price, that's called the contribution margin ratio.
The contribution margin ratio, what's that telling us?
It basically tells you what percentage of each sale is contributing to covering those fixed costs.
Okay, let's stick with the pottery studio. We know their contribution per unit is 10 pounds and their selling price is 15 pounds. So their contribution margin ratio would be 10 pounds divided by 50 pounds.
Which is 0.67 or 67%.
Okay, now we plug that into the formula, right?
Right. So we take their fixed costs, 500 pounds, and divide that by the contribution margin ratio, 0.67.
Which gives us?
Roughly 746 pound 27.
So they need to make about 746 pound 27 in sales to break even.
And that makes sense, right? If you think about it, 50 mugs at 15 pounds each is 750 pounds.
Yeah, that lines up pretty neatly. Now the guide also mentions break-even charts. How do these charts help us visualize this whole break-even thing?
Okay, so a break-even chart basically plots your costs and revenue against how much you're producing.
It's a visual way to see where that sweet spot is.
Exactly. You've got 3 main lines on this chart. The fixed cost line, which is a straight horizontal line because remember, fixed costs don't change with production.
Okay, got that one.
Then you've got the total cost line, which starts at the level of your fixed costs and then slopes upwards as you produce more because, well, variable costs increase.
Right, makes sense.
And finally, the total revenue line, starting at 0 and sloping upwards as sales increase.
So the point where the total cost line and the total revenue line cross, that's our break-even point.
Bingo. You can even draw lines down and across to see the break-even point in units and in value.
So anything to the left of that intersection on the chart, you're losing money. Anything to the right, you're making a profit. Simple as that.
Yeah, it's a really handy visual tool.
The guide also mentions margin of safety. What's that all about?
Margin of safety tells you how much wiggle room you have. It's the difference between your current sales and your break-even point. Basically, how much your sales could drop before you start losing money.
So a bigger margin of safety, the better.
The more breathing room you have.
The formula is pretty straightforward. Margin of safety equals actual sales minus break-even sales in units.
Let's say our pottery studio is selling 75 mugs a month.
And their break-even point is 50 mugs.
Their margin of safety is 25 units.
Meaning they could afford to sell 25 fewer mugs and still be okay.
Yeah, they'd still be covering their costs.
All right, we've covered a lot of ground here. We've got revenue, costs, profit, break-even analysis. Now, let's shift gears to another really important piece of cash flow.
Now, this is where a lot of people get tripped up because they confuse it with profit.
And the guide really emphasizes that these are not the same thing. Why is it so crucial to understand the difference between cash flow and profit?
Well, profit is all about looking at your income and expenses over a period of time.
It's a snapshot, like a report card on your performance.
But cash flow is all about the actual movement of money in and out of your business, day to day.
The nitty-gritty of when money's coming in and when you need to pay it out.
Exactly. You could be showing a profit on paper, but if your customers are slow payers and you've got bills piling up, you can run into serious trouble.
The guide gives a classic example. A bookstore sells a book for £100.
They paid £60 for it, so they're making a £40 profit.
But what if the customer doesn't pay for 60 days?
That's 60 days. They don't have that cash to cover other expenses.
So profit is great for the long term, but cash flow is what keeps you afloat in the short term.
Exactly. You got to manage both.
And that brings us to cash flow forecasting. Why is it so important to forecast your cash flow?
It's like having a crystal ball, or at least trying to have one for your finances. It helps you anticipate potential problems before they hit.
So you can prepare.
Exactly. You're basically projecting your cash inflows and outflows over a period of time, usually month by month.
Inflows, that's all the money coming into the business.
Sales, loans, investments from the owner, anything like that.
And outflows, that's the money going out.
Supplier payments, wages, rent, all your expenses.
And by looking at these, you can figure out your net cash flow.
Which is just inflows minus outflows. Positive means more money came in, negative means more went out.
Pretty simple math there.
You also need to factor in your opening balance, the cash you start the period with.
And by adding your net cash flow to that opening balance, you get your closing balance.
Which then becomes your opening balance for the next period, and so on.
It's a continuous cycle.
It helps you stay on top of things.
So if you see a potential cash shortage coming up, you can take steps to address it.
Chase up those late payments.
Maybe negotiate better terms with your suppliers.
Exactly. Forewarned is forearmed, as they say.
All right, so we've navigated cash flow. Let's move on to profit margins.
These are really useful for understanding how profitable your sales actually are.
And the guide breaks it down into two main types, gross profit margin and net profit margin.
We've already talked about gross and net profit.
Right. So how do we turn those into margins, into percentages?
Well, the gross profit margin tells you what percentage of your revenue is left after you've paid for the direct costs of making your products.
The cub.
Exactly. The formula is gross profit margin equals gross profit divided by revenue, all multiplied by 100 to get the percentage.
Okay, so let's say a business has a gross profit of £600 and a total revenue of £1,500.
Their gross profit margin is £600 divided by £1,500 times 100.
Which is 40%. So what does that 40% actually tell us?
It means that for every pound they make in sales, they're keeping 40 pence as gross profit to cover those other expenses and hopefully make a net profit.
Okay, so the higher the gross profit margin, the better.
Generally, yes. It means your core operations are efficient.
Now, the net profit margin, that takes everything into account, right?
All the costs, all the expenses, the whole shebang.
It shows you the percentage of revenue that's left as pure profit.
Formula's pretty similar. Net profit margin equals net profit divided by revenue times 100.
So using our previous example, a net profit of £300 on a revenue of £1,500.
That's a net profit margin of 20%.
Meaning for every pound in sales, they're keeping 20 pence as pure profit.
That's the bottom line, literally.
Okay, last but not least, the guide talks about the average rate of return, or ARR. This is for when you're thinking about making big investments, right?
Yeah, like buying new equipment, upgrading your facilities, big stuff.
So ARR helps you figure out if it's worth splashing the cash.
Exactly. It gives you an idea of how profitable that investment is likely to be over its lifespan.
And a higher ARR generally means it's a better investment.
More bang for your buck.
Okay, so how do we calculate this ARR?
First, you got to figure out the total profit you expect from the investment over its entire life.
Total revenue it brings in minus all the associated costs.
Then you divide that total profit by the number of years the investment is expected to last to get your average annual profit.
Okay, so far so good.
Finally, you divide that average annual profit by the initial cost of the investment and multiply by 100 to get the percentage.
Formula time. ARR equals average annual profit divided by initial investment cost times 100.
Let's take a look at the example from the guide. A company wants to invest £80,000 in some fancy new equipment, and they think this equipment will help them make a total profit of £120,000 over the next 5 years.
So first we need to figure out the average annual profit.
That's £120,000 divided by 5 years, which is £24,000 per year.
Then we take that £24,000, divide it by the initial investment of £80,000, and multiply by 100.
Gives us an ARR of 30%.
Meaning they're looking at a 30% average annual return on that £80,000 investment. Not bad.
Not bad at all.
Now, of course, with all these formulas and calculations, there's always room for error.
Yeah, the guide highlights some common pitfalls to watch out for.
What are some of those mistakes people often make?
One of the biggest ones is mixing up fixed and variable costs.
Easy to do if you're not careful.
And that messes up your break-even analysis big time.
Right, because your whole calculation is off.
Also, people make mistakes applying the formulas themselves, whether it's for break-even profit margins or ARR.
Those formulas can be a bit tricky.
Another common one is misinterpreting break-even charts.
Yeah, you got to make sure you're reading them correctly.
And of course, the classic cash flow versus profit confusion.
We've talked about that, but it's worth repeating.
Treating them as the same thing can lead to some disastrous financial decisions.
And let's not forget those good old-fashioned calculation errors.
Yeah, everyone makes them.
Double check your work, people.
Absolutely. And with profit margins, don't forget to multiply by 100 to get that percentage figure.
Right, otherwise you're just looking at a decimal, which isn't very helpful.
And for ARR, make sure you're using the correct profit figure.
Total profit over the investment's life, or the average annual profit.
Easy to get those mixed up.
And when you're calculating the break-even point in units, remember, you almost always have to round up to the next whole number.
You can't sell half a cupcake.
Exactly. Now, the guide wraps up with a really helpful FAQ section. Let's quickly run through some of those key questions.
Okay, fire away.
First up, what's the fundamental difference between revenue and profit?
Revenue is the total money you bring in from sales.
Okay.
Profit is what's left after you've paid all your expenses.
Simple as that.
Simple, but important.
How about this? What's the easiest way to tell if a cost is fixed or variable?
Ask yourself, does this cost change directly with how much I produce or sell?
If it does, it's variable. If not, it's probably fixed.
Most likely.
Why is break-even analysis so important for businesses, especially new ones?
It tells you the crucial minimum you need to sell to stay afloat.
Gives you a target.
Helps with pricing decisions, understanding your business model, all that.
Okay. Is a high profit margin always better than a low one?
Well, in general, yes. Higher profit margin means more profit on each sale, but it's not always black and white.
Right. Sometimes a lower margin might be strategic, like if you're trying to gain market share with competitive pricing.
Exactly. You got to look at the bigger picture.
Why should businesses bother forecasting their cash flow?
It helps you avoid those nasty surprises.
Like running out of cash when you need it most.
Exactly. You can plan ahead, manage your money proactively.
What does it mean if a business has negative cash flow?
Simply put, more money went out than came in during that period.
Could be a sign of trouble.
Yeah, might need to look into that.
Just to recap, what's the main difference between gross profit and net profit?
Gross profit is profit from your core business before other expenses.
Okay.
Net profit is what's left after all expenses are paid. The real bottom line.
And just to reiterate, most businesses will have some fixed costs, even if they're small.
Almost always, yeah.
And if your sales are below break even, well, you're making a loss.
That's the hard truth.
All right, well, we've covered a huge amount of ground today. From revenue and costs to profit margins and ARR, we even tackled break-even analysis and the all-important cash flow.
It's been quite a journey.
Yeah, it has. But honestly, I think everyone listening should now feel a lot more confident tackling these core financial concepts.
Yeah, you've got the tools now.
Whether you're running your own business, thinking about starting one, or just want to understand the financial world a bit better, you're in a much stronger position now. And hopefully it sparks some thoughts about how businesses can really manage their financial health strategically.
Definitely. There's a lot to consider.
So here's a final thought for you all to chew on. How much of an impact do you think even small changes in pricing or costs can have on a business's break-even point and overall profitability?
Interesting question.
What levers do you think businesses have the most control over when it comes to keeping their finances in tip-top shape? Something to ponder.
Something to ponder indeed.
Yeah, thanks for joining us for this deep dive into business finance.
We'll see you next time.
See ya.